Well, from a strictly stock market perspective, if you look solely at share prices and valuations of a lot of consumer names over the past 6 months, one would think that the consumer is struggling, consumer spending is dissipating, and the outlook being priced in on a lot of these stocks is grim. So that's what the stock market would show you, as equal weight discretionary is down about 3% year to date versus equal weight market up 12%, underperforming by 15% over the past 6 months. The market has gotten so negative on consumer stocks, the consumer discretionary sector now holds a sub 10% weight in the S&P 500, which is often characteristic of a very weak economic environment. So looking at the sector and stocks as a whole, how much have they underperformed the market? You would assume that these companies have been missing their earnings expectations, forward consensus estimates would be decreasing, and management teams were speaking negatively on the consumer and their ability to spend, all of which has not happened. On a stock-specific level, most companies so far this year have actually delivered against earnings expectations, with management teams largely affirming outlooks and speaking quite positively about the consumer. So what has happened? Why have these stocks and the sector as a whole performed so poorly? Sentiment. Investors have been completely irrational on the consumer. And the first part of the year was driven by AI fears, i.e. AI is going to replace humans and the unemployment rate will skyrocket and no one will have any disposable income, which then moved to gas price inflation, which became nearly apocalyptic on consumers' ability to afford gas, believing all other discretionary spend would suffer. Despite the negative sentiment, this worst-case scenario has yet to materialize as the consumer remains incredibly resilient, which created a real buying opportunity during the first half of the year as stocks became mispriced. We continue to have a positive outlook on the US consumer sector for the back half of the year, and while the glass always seems to be half empty for investors, and you can probably almost always find a data point that would feed into the bear case, at the end of the day, the number one determinant of consumer spend, the labor market, i.e. do people have jobs, remains stronger than expected, fueling strong consumer health. Furthermore, the overall health of the consumer is broad-based and not just focused on upper-income households. As recent data highlights, we are moving away from a K-shaped economy to a more balanced E-shaped economy. At the end of the day, while we may be operating more in a capex-driven cycle rather than a consumer-led cycle, sentiment had become way too disconnected from fundamentals, and so we are very positive on the consumer sector into the back half of the year.